I think we're just waiting for Harry. I think he logged in as an attendee rather than as a panelist. So we're just waiting for him and then we will start. Thank you for your patience for all the attendees who've joined us today. We're just going to take a couple of more minutes and then we should start this formally. Whilst we wait, I'm just going to explain my Rajasthani attire. I am speaking to you from Jaipur and as a matter of fact, attending a wedding, an Indian wedding here. So hence my outfit. I hope you'll excuse the outfit, makes it a little more colorful. So I said, might as well go with the flow. We're just waiting, I think, for Harry to rejoin and we can commence the deliberations for today. Priyanka is going to do the needful as soon as Harry joins, which should be, yeah.
Who's that?
Welcome, Harry.
Welcome, Harry.
Hi, morning.
Hi, so we're going to start and I'm going to hand over to Priyanka to take us through the formal deliberations for the webinar today.
Good evening, everyone. I extend you all a warm welcome to this panel discussion on how to find the right startup idea, organized by RNM India. As they say, in dream lives begin. A brief on RNM. It's a consultancy firm operating from last 75 years, spanning 3 generations from Delhi, Gurgaon, Bangalore, Raipur, and London. At times, you know you want to start a business, but what do you do next? Finding the right startup business is one of the most popular small business subjects today. Riding the wave of the hot market is much easier than spending all your time and resources educating a market without a real need. So finding a hot business opportunity is the first step. Before we begin the webinar, I would like to introduce and convey my gratitude to all the panelists who have joined us to share their experience and expertise. Mr. Amit Uppal. Amit has over 20 years of experience in real estate, private, and technology. He is a trusted advisor to Fortune 100 companies and financial institutes on their technology and capital strategies. Previously, he has held senior management positions in organizations like Fire Capital, Cognizant, and Infosys. Panelist, Mr. Cendrowski. Mr. Harry Cendrowski. Harry has worked hand in hand with businesses, family offices, private equity, and venture capital funds, attorneys and non-profit organizations to their needs for over 35 years. He is a veteran of private equity and venture capital industries, where he has worked with potential portfolio companies. Our third panelist, Mr. T.K. Peer. Mr. Peer has more than 35 years of diversified experience in financial sector and heads the consulting division of RNM Consulting. RNM Consulting is an assertive firm providing virtual CFO, payroll management, and ESOP services. Our fourth panelist, Sumit Singh. Sumit has 15 years of experience in direct taxation domain. He has wide experience in evaluating and providing opinion in UK-India and Germany-India tax treaty. Sumit handles merger strategies and restructuring strategies for overseas companies based in European continent. Our next panelist, Mr. Varun Verma. Varun brings over 15 years of rich experience in areas of mergers and acquisitions, fund mobilization, private equity, valuation, and asset management. He has worked for multiple complex transactions across sectors like real estate, ITs, logistics, hospitality, healthcare, manufacturing, BFSI, telecom, aviation, etc. Last but not the least, I would like to introduce our host, Mr. Raghu Marwa. Raghu is the managing partner of RNM India and is leading the firm. His expertise is on advising and structuring businesses abroad on behalf of Indian corporate clients, entry strategy for foreign clients, businesses in India. Transfer pricing and overseas taxation matters are also part of his repertoire. Before I hand over to Mr. Raghu Marwa to moderate the ensuing session, may we refer and be glad to have your questions or please pose the session and our panel would be happy to address the same. Thank you. Mr. Raghu Marwa, may I request your moderation, please?
Thank you, Priyanka. Thank you for your introductory remarks and welcome to everybody on this webinar today on how to find the right startup idea. We have in the past done a series of how-to webinars, starting with how to scale a startup in June, how to raise money in September, and now how to find the right startup idea in the month of November. Our next webinar would be on how to identify the right jurisdiction for your startup, considering how many startups are looking at Singapore and other jurisdictions to seed their startup at. Starting a company is like climbing a steep mountain. You need to take the time to prepare your gear. With that, I'd like to quote Michael Jordan, the legendary NBA player, who said, "I've missed more than 9,000 shots in my career. I've lost almost 300 games. 26 times I've been trusted to take the game-winning shot and missed it. I failed over and over and over again in my life, and that is why I succeed." So success is a mantra that obviously comes with hard work, and so is the whole idea of finding the right startup idea. Because the right startup idea doesn't come easy in a eureka moment. It comes from hard work and repeated failures. Coming back to the topic on hand, the simple answer to what is a right idea is the personal problem for you that can be scaled up, for which customers would be willing to pay. Most often, I think founders go wrong in not being passionate and personal to the cause at hand. And for this, you may like to do the following. Keep a log of things that you use that suck throughout the day, things that you don't find are going right, how you can make them better. That may be an idea that you want to pursue. Look through your business and personal credit card statements to see if there's anything that you're spending too much money on or overspending on that you feel that you can reduce the price, reduce the cost, create a disruption on. If you are with a company, think about some of the issues that you face. Is hiring the right manager painful, or is collections an issue? That may give you an idea of the kind of pain points that other business owners or employees are experiencing. After all, humans want comfort in their lives. They want comfort so that we can all focus on the things that we enjoy on, and how technology through startups can achieve that is the big game changer. Forbes gives 3 top business ideas of 2021 as freelancer, writers and bloggers, videographers or photographers, and graphic designers. As you can see from this list, the gig economy is going places in 2021, and I'm sure the rest of the panelists would concur to that as we move ahead. The process to evaluate the startup idea would include an objective assessment of the following: whether the founder has the right passion, the market size is big enough, whether we are willing to take the right risks, whether the competition in that space is too much or too little, whether you as a founder are willing to sacrifice the work-life balance that you are willing to, that a startup needs. And again, over here, I'd like to quote the co-founder of PayPal, who is also the author of the book called 0 to 1 by Peter Thiel, who says a company should start when they have a technology that's 10x better than their closest competitor. So clearly we're talking about a disruption, and that's where the startup industry looks to find the big right idea. As per another leading VC investor and founder of Made and Not Born, founders are made and not born, called Miss Mercedes Bent, she goes on to advocate the following mantra to choose a good idea. A, do you have the burning idea? B is, can you make that burning idea your life purpose? C is the business model or category. Does it have a proven track record of, say, valuations or other metrics? Can you identify a clear trend or a change in a trend, such as consumer trends or habits which are changing? Do you have an unfair distribution advantage? Because it's all about distribution to scale up. And finally, do you have the right founder market fit? As in, are you the right founder for that market? We have various models or academic studies which Stanford and other leading schools will advise. Some of them are called the job to be done framework, JTBD as they call it. And JTBD framework is a great way to understand your customer needs rather than for you to just wing it. Whether you are an early stage founder or an investor, a clear JTBD statement should help you communicate with absolute clarity what a specific group of people want in specific circumstances and the barriers to getting it. To pressure test ideas emanating from the JTBD statement, assess startup ideas against the following criteria. What are the functional needs? What are the emotional needs? Whether it's a billion-plus market, and whether it's got a breakthrough UX. These days, it's all about the user experience, and I think that's becoming very big. But enough about, what I think. I think with that, I'm going to quote Benjamin Franklin, who said, "Diligence is the mother of good luck." And clearly, the startups of today need all the good luck, and that comes from diligence. And with that, I'm going to go to my first speaker, who is Amit Uppal, and hand over to him for sharing his experience as to how you chose your startup idea and what have been your experiences, maybe some of the hits and some of the misses. So with those introductory remarks, I'm going to hand over to Amit for your comments. Over to you, Amit. Thank you.
Thank you, Raghu, and thank you, RNM, for having this session and inviting me. I clearly love the topic. I'm an entrepreneur, so such kind of forums really help me talk about what we are doing, which is always lovely. So, and that kind of brings me to the point that you seem to be having fun in Jodhpur. So one of the key things, what I must add to what Raghu has already mentioned in terms of frameworks, is that the idea that you choose, you should have fun, because it's going to be a very painful, long, arduous journey, a lot of challenges, a lot of pitfalls. But if you're not clearly having fun, trying to work on that idea, then you're starting off on a wrong note. And it's not just about the idea, it's also about, a lot about execution. So I think execution in itself should be another session, but since the topic of this session is to how to come up with a purposeful idea for a startup, I must say that, I must say that I come from both sides of the table. I have been investing in companies, investing in ideas. And now that I'm an entrepreneur, I am selling my idea to be sold to both investors and our users. So how do you look at an idea? It means a very simplistic definition of an idea is that, there's a problem, there's a solution, and there is a USP. That USP is how you specifically plan to have an edge over others when, everybody is trying to look at that same problem and kind of trying to address it through a certain generalistic solution. So if you since Raghu kind of spoke about Mercedes-Benz, Peter Thiel, he spoke about a lot of frameworks, and I'm an MBA. I would like to also talk about certain frameworks. My personal favorite, when I look at an idea, is if you can put it somewhere in the matrix of inspiration, competence, and sensibility. Now, let me explain to you in the context of what we are doing. We are running a startup called Frxnl. It's a fractional ownership platform in real estate. So if you were to look at it from a problem, solution, and USP framework, problem was that RE, we use simplistic, acronyms, but RE is real estate. Real estate investing in India is largely skewed towards residential, to a low yielding asset, and it's massive. Means over 80% of the country's wealth is actually allocated in real estate. So that is in itself a huge area for anybody to break down and start addressing. Whichever way you look at it, real estate is actually a huge idea, so huge market opportunity. So what we wanted to do in terms of a solution is basically give the option of a professionally chosen and a professionally managed investing option to the same investors, basically trying to bring down the pain which is associated with buying and holding real estate. Now, our USP in this whole approach is that to give them a paperless way of investing, which is kind of unheard of. When you think of real estate, you think of brick, mortar, lot of processes, lot of visits, and ours is a completely digital and a paperless way of investing and managing real estate. Now, this sounds fancy, hopefully, but how did we come around to it? So that is where, my personal framework comes in as to how one should look at an idea for themselves. So if we look at the inspiration, we are 3 co-founders at the firm. I and my second co-founder, we come from a private equity real estate background. So real estate has always been, around us. We've been surrounded by that, and it naturally has evoked a lot of inspiration, motivation to do something to change one of the biggest industries in somehow a fundamental way as to how people kind of look at investing in this industry. And competence, certainly we do bring competence. So when you are looking at an idea, you may be awed by the latest me show or say another fanciful fintech idea, but competence is key to execution and success of any idea. So we believe that we bring that competence because we have been on the side of sourcing and managing very large real estate investments. So we can bring that prudence on the table, not us, but also a lot of our advisors and investors are helping us achieve that. That brings me to the third question, which is sensibility. Sensibility comprises a lot of ground. It is largely about, when you're looking at an idea. So like they say, most of the idea that you get in your while you're taking a shower. So, but for an idea to travel from a shower room to becoming a multi-million-dollar idea, it has to go through multiple checks, validation. You may have a wonderful idea, you're super excited about it, but can it meet, say, a proof of concept? How long does it take to achieve that proof of concept? Do you have the cost? Do you have the ability to reach at that, basically achieve that? Once you have the proof of concept, the journey starts. So, everybody loves to talk about that big idea, but I think a startup is more about a journey or say a path rather than just an idea. Because at any point in time, a lot of people may be thinking a variant of your idea. So to achieve that path, you basically have to look at not only your surrounding variables, environment, and continuously look at that, but at the same time, look at your abilities to execute that. So when we were looking at Frxnl, Frxnl is essentially a COVID baby. So having said that, basically what COVID did was it triggered digitization. It kind of accelerated the whole adoption of digitization by 5 years at least. People wanted a second income and people were moving to online purchases heavily. So, and real estate was still stuck in the old quagmire of you go to the registrar's office, you go work with the completely broken channel of brokers, And you are essentially sweaty and tired by the time you have one real estate. And what Frxnl does is allows you to basically gives access to prime properties, and you can invest in small sums. You don't have to get stuck in the whole sphere of EMIs and mortgages. You can invest a small sum, at 20 lakhs, about a $30,000 is what you need to invest in, say, a heart of city project, and it kind of starts generating yield for you. So which was solving the second income, or what the fear people had that I may not have a job anymore. The world is changing so fast that I may not be relevant anymore. I need to survive. So second income is important, and all these things have really taken shape. Today, within say 1.5 years or 2 years, we have seen fractional ownership industry actually move by at least 2.5 times. That's just the effect of COVID. Means COVID has definitely created a lot of different businesses. It has broken down a lot of business, but at the same time, such challenging environments actually give birth to a lot of opportunities too. And we believe that it's important to have that sensibility. It is important to have that awareness. It is important to validate your assumptions. It is important to talk to anybody and talk to, in forums like this, take as much feedback. And, that is when an idea or your journey basically begins. Thank you.
Very well said, Amit. I'm sure there are going to be lots of questions. And, I think you put it very well that I think a journey of 1,000 miles begins with the first step. And there are always pivots that will happen along that journey. But I think a founder's journey is never easy. With that, I'm going to move on to our next speaker, Mr. Sumit Singh, who's going to talk a little bit about the legal requirements from a tax perspective of how to start a venture. And over to you, Sumit ji.
Thanks, Raghu. Hi, good evening, everyone. So startup is basically, it's all about bringing innovation, developing new product, bringing new technology, improving the current process. And in a way, this startup helps in increasing the wealth and employment. So that has been the basic intent when government started talking about these startups. Having said that, while government is being being encouraged to bring this startup model, at the same time, they have provided certain relaxations also in terms of undertaking business. And there are certain relaxations in terms of under the Income Tax Act also. So in this session, we'll put this discussion in two buckets. One is related to what is the relaxation in business and what is the relaxation on the income tax front, because it may have some correlation between starting up with the startup idea. So as far as government benefits are concerned, they have just provided a very simple mobile app through which you can go ahead and file an application before the Ministry of Industry, and they will just and you will have to substantiate that your product is a unique kind of product bringing some innovation, or it's a new idea or a new technology, and basis the substantiating that one can be eligible as basically as a startup. Then subsequently, there are other benefits also, because then startup is innovation and idea, so they may want to protect their inventions or their ideas. So it can be through registering the trademark, patent, and the cost of registration of trademark and patent has been quite lesser as compared to the other course of the business. Plus, government has been very proactive in terms of providing funding facility also for startups. So they have specifically created a fund of approximately 10,000 crore rupees, a fund which could facilitate the fundings for these startups. And then there are some prevalent industrial law in India, and they have been given certain kind of relaxation, like they can just comply with those industrial laws basis upon some self certification and all this. So, and another is like government is encouraging to bring in some research and development also. So they are intending to put up some research and development parks also. So these are the basic thoughts of a one. And of course, if somebody wants to exit from a startup, so exiting is also quite comfortable, unlike other entities where you just within period of 90 days from the date of filing of application, one can exit out. So these are from the ease of doing business. And but a most important point is who can be a startup from a legal structure point of view. So from a legal structure point of view, a startup can be a private limited company and a limited liability partnership, or a partnership firm. So when we are discussing about startup idea, it is imperative that at the first instance, one should think about what kind of structure one may want to move, because there will be some motivations of investors also, and there are tax rates also. Like in case of a company, of course, after the expiring this tax holiday, their tax rate in a company will be different, and in case of a partnership will be different. But of course, in case dividend wants to seek the return on their investment, then in case of a company, it's a dividend, and in case of a partnership, there is no requirement of paying or returning to investor through dividend. It could be other modes also. However, thing may slightly shift if there is an investor from overseas. Then would that comparison will still be applicable or not? These are the important points one should ponder upon when you are bringing a startup idea at the front. So there should be a complete analysis, or there should be a professional advice towards what should be the legal structure of entity. So now coming to the second aspect is what all are the tax benefit being given to a startup. Basically, startups are eligible for claiming a deduction against their taxable profit for the period of 3 years. 3 years means continuous period of 3 years out of a window of, say, period of 10 years. So these 3 years has been pretty thoughtful on the part of government, because in the initial year, startup may not be making too many profits. So there is no requirement as such of claiming these tax holidays or tax reductions. And suppose in 7th or 8th or 9th year onwards, an entrepreneur start making profits. So in that particular year, you can start considering claiming your tax benefits. So one can also think from that point of view, what could be the proper timing when one should, start claiming the tax benefits. And other issue, but when this income tax act comes, so it comes with certain issues also, and there are certain expectations also, whether those expectation has been fully met or not. One have to analyze a bit more, because devil lies in detail in first. Because suppose here I'm referring to a word called permanent establishment. So as a short abbreviation, I may be using the word PE, but request you to not to confuse with the private equity over here. So what happens, suppose it's a holding subsidiary relation in India, and there is an overseas holding company has invested in an Indian subsidiary. So typically the way the business model is being operated, there is an issue of a permanent establishment issue in case of in such kind of a business model. So once this and the meaning of permanent establishment is that it becomes akin to a foreign company. Suppose if Indian subsidiary is alleged as a permanent establishment by Indian tax authority, so it altogether becomes an akin to a foreign company, and the tax rate of course changes. And if there is a change in the tax rate and it becomes akin to a foreign company, whether they would still be eligible to claim the tax holiday for the period of 3 years, which we just talked about. And that is, in our view, is a slightly a gray area, and there is no clarity as such on. Indian government still want to, get the conflict. There are other benefits also, like startup would certainly require funding, and funding in a startup can be through domestic investor or could be through an overseas investor. So in case, if we specifically talk about domestic investor, and suppose they are infusing certain funds in the form of equity capital, so there are certain laws which says that one fresh subscription is given to a shareholder, then the issue price of a share cannot exceed the fair market of value. Suppose you have a fair market value of your business, say 100, and you are issuing share at 120 rupees, then 20 rupees become taxable in the hands of the entity issuing those shares. So, but there is a specific exemption in case of startups, but there is a limit to that. If they are looking to raise funds to the extent of 25 crore rupees, which is an aggregate of paid up capital and share premium, to the extent of 25 crore, they are having a specific exemption. And in a situation where their issue price of a share exceeds fair value, then still they will not be subject to tax, unlike other routine kind of an entity. That's the one good thing which tax authorities have provided. But when we talk about a non-resident investor, such kind of issues are not applicable in case of a non-resident investor. So you are pretty flexible in terms of putting a issue price, but typically department comes up with another kind of issues when there is a non-resident investor looking to take an exposure at India level, whether that fund being infused are genuine funds or what has been the source of those funds, and there is no like rounding of money from India and then money coming back to Indian business. So the department has been issuing notices to startups and trying to get into the genuineness of the transaction, even in case of foreign investors also. So over there, I think there should be more clarity from tax authority side, and they should be more choosy before they upfront pick up some startups matter all of a sudden for scrutiny. There should be some level of, I think, detailed analysis, and there should be some sort of questioning before jumping on to a situation where this is a matter for a scrutiny. These kind of a provision, I think, will be welcomed, and this should be one of the expectation of any startup or being an investor over here. So another aspect, another issue, however, what will be the situation when an investor is exiting out of a startup? So when you are exiting, there is another law at India level which says that you cannot sell the share below a minimum valued price. And the mechanism or you can say guidance for calculating that price of sale is given specifically under the Income Tax Act. And there is no specific exemption or any specific benefit given to any kind of a startups also. For example, if there is a Indian investor and he has infused certain funds in an Indian startup and now he wants to exit out. So at the time of exiting, suppose he wants to take, suppose, 2 million out of his investment, and the valuation comes, say, 2.5 million. So he cannot, deal below 2.5 million. Otherwise, there will be a taxable issues in the hands of the investor as well as in the hands of the person selling, or seller and buyer tax issues it will come. So I think there should be more relaxation on that front. However, when we are talking about starting a startup idea, so one can, think at the upfront stage, what kind of funding one can, infuse, and what kind of instrument one can choose at the time of investment. So be it in the form of an equity share, be it in the form of a preference share, because preference share valuation is not strictly guided by that rule, and there is some flexibility exists, or it could be through OCDs, means optionally convertible debenture or convertible debenture, or it could be the mix of both equity and debt. But all this, I'm not giving any conclusion at this stage, but this is all very specific factual exercise, and one has to drill down at the level of expectation in business environment before particularly choosing what could be the nature of entity, private limited.
Absolutely. Thank you
LLP.
so much, Amit sir. I think unfortunately we are running out of time, and tax is a subject which I think we can keep on deliberating. It's a detailed and interesting topic, but in the interest of time, I'm going to request that we move on. Thank you so much. We did take a poll question while you were speaking. We're going to very quickly launch another poll question for our audience on financial risk, which would be on your screen right now. And I request everybody to, give their response on that before we move on to our next speaker, who would be Mr. T.K. Peer, who's going to talk about managing the startup financial risks. And as we all know, the devil is always in its detail. I think Amit had mentioned that earlier. So managing risks and managing day-to-day operations is a big challenge. We have the response to the current poll question, and I think majority everybody has said that choosing the right investor goes a long way in mitigating that risk. With that, I'm going to request Mr. Peer to share his thoughts. Over to you, Mr. Peer. Mr. Peer, I think you're on mute.
Good evening, everybody. So talking about the startups, see, the biggest startups, most of the startups generally fail. This is an unfortunate, but it's true. Most of the startups must start very small. In fact, the other day somebody was talking that most of them start from a garage or a room, one room somewhere. But the journey is long and arduous, as Amit has said. It's a long journey. You have to. It's not only important to have an idea, but you have to have the wherewithal, capacity, capability, and what you call that passion to go along the journey, which is a very long one. See, the biggest risk in what you call startup is the financial risk. In most of the startups, what happens that the startups generally fail because after some time they run out of cash, and till that time they don't have achieved the milestones which would be required to get the investor on board, and that's why they wind up. So if you have a startup idea, first of all is to have the right capital strategy in place, so that you should look for a window of 18 to 24 months, not 6 months or 1 year, because we have seen last year what happened, that COVID came in suddenly and everything went for a toss. So they should have sufficient cash to ensure that they can survive for 18 to 24 months, and that cash should enable them to achieve some milestones which they can present to the investor and get an investor on board. So the sufficient cash availability is very important, not only to stay afloat, but also to ensure that you are able to get an investor and the right investor. So now what kind of investor you need? There are various funding options, For a startup, he first looks at friends, relatives, family members, and all. Then there are seed funds, venture angel investors, venture capitalists, and all that. So all the investment from all these channels comes with different types. As Sumit just said, it can come as equity, debentures, convertible, non-convertible, whatever it is. So it's a mix of funding options, and these these investors provide different kind of investment, and then again the rates and costs are different. So what's very important that you have to choose the right kind of investor. In some cases, even government support is available for some kind of investing. So some kind of startups. So basically, you have to choose the right kind of investor and right kind of investing mix that would be best for you. And then once you have looked at these sources, then you have to do some kind of due diligence first on yourself, that whether your things are in order, whether you have complied with other statutory compliance, whether everything is in place. See, first of all, that business plan has to be there. We are starting from the premise that you have a business plan, you have an idea which is saleable, which is scalable, and it solves a problem. So that's presumed that once you have a startup, you have the idea. So you have to have a business plan which details where all will sell, what is the market, what are the technological challenges, what are the competitors, what is the pricing, and all that. So coming back to the investor, once you have selected that an investing channel, you have to kind of conduct a due diligence of your own business first, whether there are any non-compliances, whether there are any issues and all. Then after that, when you get the investor on board, you have to have the right kind of documentation with him, whether it's a shareholders agreement, whether it's a loan documentation and all. You have to clearly see what are the powers, what are the liabilities that investors get in. You have to define like what are the veto powers, who can come in at what stage, who can leave, what are the different options, and what are the liabilities, what happens in the event of default and all. That means these loan documentation, investors agreements have to be gone through a fine tooth comb, so that you don't land up in a situation tomorrow where you are caught up in a very bad situation which cannot be resolved. So that's another part of it. So once you have the loan documentation and all in place, business in place, then you have to look at, see, there are other risks also. You have to mitigate those risks. Suppose it is a currency risk. If the investment is coming in a foreign currency, then you take the currency risk, because when the money has to be repatriated, you will be at those rates operating at that time. Then maybe you need to go in for some kind of currency hedging. Then your interest rate risk is also there, that whatever you borrow, the interest rates might go up, may upset the business plan. So what is important is that the business plan you get, you have to do a sensitivity analysis, like what happens if costs go up, what happens if my prices come down, what happens if I don't sell for some month. All those things have to be factored in the business plan. And then the most important is, what is the data you present to the investor. The investor should get a comfort level that whatever data you presented, it should tie up with the financial plan of the company and the overall vision. Overall, it should be in what you call sync with the pitch deck as a whole. That, so what's important, that what data you present to the investor, in what form it's presented, is it tallying with your financial presentation and all, and whether it's tallying with the essential elements of the pitch deck. So these are the vital factors that have to be taken into account when going for fundraising in this startup. And in this process, what happens generally, startups, what they do is they may hire an accountant and all to do some minor bookkeeping and all, recording transactions, do some minor reporting and all. They don't feel the need that they need an expert. But once you take this into account, you know that you have to have a professional CFO. A professional CFO who can guide you through this journey, because all these risks are there. Because again, coming back to the same point, it's a long journey. It's not a startup. It's not a 2 month, 3 month, 6 month job, and it's a startup. Is a startup of a journey, long journey. So you should have your systems, procedures, control points in place, so that this journey is very smooth, and you know what are the risks, and you know forecast. You can get a good forecast and all, what is going to happen and all. So that is why the role of a CFO comes in very important for a startup. See, some of the startups, as we have seen during COVID crisis, most of them, in fact, cannot afford a full-time CFO because the costs are prohibitive. In fact, that time, some of the existing companies, not startup, which are in regular business, what they did is they resorted to fractionalization of CFO services, that you hire a CFO, a fractionalized CFO service, hire a virtual CFO. He looks after your what you call inter-controls, statutory compliances, your Frxnl balance sheet, financial statements, and all remotely, and budgets and targets and all. And then periodically he meets with the management and appraises them of the financial health of the company and assists them in planning for the future. So this fractional CFO service is one of the good tools for startup to ensure that its journey is properly done, so that it is in what you call, it's properly equipped to handle what is lying in store for it. It knows where it's heading, and that's where the role of a CFO comes in the process. So basically, these are the risks that you these are the risks that come in for a startup, and this is how a virtual CFO or CFO can help you mitigate the risks. And but the most important factor is your business plan, your idea. It has to be perfect. It has to be something unique, as the speakers before me have already underlined. It has to be be something very special. It should solve a problem. It should be scalable. It should be something, and it should be, the technology should be 10x times as compared to the latest that is available, as Amit has said it. So basically, that is to sum up, these are the risks in this startup.
Thank you so much, Mr. Peer, for your deliberations, and I think you're spot on. Anything which is going through a hyper growth and such a fast pace of change requires a lot of careful monitoring, and I think the CFO's role over there is very critical. Whilst we're talking, and I would like to, Harry, as Priyanka had earlier said, is obviously an expert on the whole startup ecosystem, but is also a dear friend from Geneva Group International, which is an organization which both of us are from, which I thought let me also highlight before inviting Harry to give his deliberations on his thoughts on product differentiation, service differentiations, and what is his experience, and from a US perspective, what are the things that you are looking in at that ecosystem? Over to you, Harry.
Thank you so much. Good evening, everyone. It's actually good morning in our neck of the woods here in the United States. but thank you for inviting me here. I think Amit, said it perfectly. You have to have a proof of concept with respect to whatever product you have, whether it's a medical device or whether it's software. And the one thing to focus in on is every startup is not just tech oriented. So what I wanted to talk about here today is, you really have to look at the founders, and this is something Amit was talking about, is what is their experience? What are their connections? Have they had prior exits? Who are their partners? Because those are the people that are going to allow you to be successful, because you're going to get different points of view with respect to what it is. So I'll talk about one particular case that was not successful, and I'll tell you the reason why it wasn't. So it was a medical device to allow people to get pregnant, because there is a problem in the world today with respect to pollution and with respect to things that people are having a hard time getting pregnant. So this medical device has a patent. It actually was approved by two different religions, by both the Catholic religion and Judaism. But what they didn't understand, that what they were going to run up against, was the fact that it is disruptive. And what disruptive means is that it was going to take the current method of people getting pregnant and change it. And when you do that, you have a lot of people who already have money invested in the ecosystem that don't want things to change. So you have large insurance companies, you have large employers, you have other people who just don't want to see things change, both from a religious and from a product standpoint. And in this particular case, absolutely great product. It works, they got buy-in. But the one area they didn't get buy-in was the constituency, which would have been Catholic hospitals and the other large organizations. So they did everything else right, but they didn't get that buy-in. So they thought they could do that down the road. And what happened was, because it took them such a long time to get the patent, to get the medical approval, insurance, and things of this nature, it looked like an old idea to new investors. So they had it. This took them 8 or 9 years. Well, that takes a long time and a lot of money. So you're talking to new investors. They want to know why you haven't been successful. So you have to look at each industry a little bit different. Medical tends to take a longer time, up to 15 years. To be successful, but you have to be careful in how you do it. It's like in the diabetic area, there are probably 20,000 startups on some form of diabetic aspect to cure certain things. Probably 1% of those are only going to be successful. So you have to be really careful about who the founders are, what are their connections, and can they really focus on their constituency. On the other hand, we were involved with a company that started off doing machine reading, AI, and what they did is they started very small with respect to doing repeatable tasks with respect to AI and using bots. And what they did is they knew that their system was going to change over time. So they had very experienced management and very experienced investors. So what they did is they focused their time on getting a handful of very large companies to do this on a test basis. So therefore, they were able to actually get into the minds of these different companies in different industries and get their feedback. And that's where they spent their time and effort. And now it's a highly successful company. It's one of the top Microsoft partners in the US and is expanding. And now they're actually into the cloud. So what Amit and what everyone else is saying actually fits very well into this. Once you have proof of concept, that's fine, but you have to look at what's the rest of the things that you have to accomplish to get there. And at the same time, you have to look at who are your competitors. And trying to find out who your competitors are in a startup mode is very difficult because you don't have a lot of data points on them. But the whole idea there is that you have to look at this. We were talking a little bit about pricing on these things. Remember, when people are investing in the startups, what they're doing is they're really they actually price it. They don't value the company because their investing might say, I need to get 3 or 4 times my money. So they have to see who you're going to sell to down the road, 3, 4, 5 years. And if they can't identify that, they're not going to invest. So you might have a valuation that's at one level, but the fact of the matter is they price their investment if they're a smart investor. And that's how they're going to look at it. So the big thing here is make sure that you have a great team, a great ecosystem, and your investors are going to be, if they're just going to be passive money, that's great. I would rather have smart money with me because they're going to have the connections. They're going to have the capability to open up doors that you wouldn't be able to open up in a time frame where your product is still going to be first to the market. Because if you're second or third to the market, you're just not going to be the same valuation. So that would be my comment with respect to the investing. But I think everything that Amit and everyone else said, it gives you that framework, gives you that, as TK was talking about the fractional CFO, all that is a very part of the ecosystem. So remember, this is a process, and at each part of the process, I think Amit mentioned that you have multiple checks, multiple validation, and you also, it's just all part of the journey. But you have to understand where that journey is taking you, because if you don't do that, it will not be a successful startup.
Absolutely. Thank you so much, Harry. I think that was very insightful. And I think the 2 case studies that you shared, I'm sure, also kind of hit the nail on the head and kind of illustrated the difference between a good idea and a not so good idea and the perfect timing for it. With that, we've got a poll question, which is on your screen right now, about the differentiation of your startup. And I think we've got the response, which is, I think majority people think that you should focus on just one thing. And I think that's not a surprise to many, because a lot of, super apps are going around, which will try and do a lot for a lot of different audience. But I think doing just one thing really makes. So with that, I'm going to switch gears and invite Varun. I think we had talked about it. Harry talked about it. One of the ways to pressure test an idea is really go out to the market and try and raise money. And I think with that, it comes always down to fundraising and the strategy to be adopted. So Varun, why don't you share your ideas on that and your personal experience? Over to you, Varun.
Sure. Thank you, Mr. Malwa. So very good evening, all my brothers and sisters attending this webinar today. So friends, as Mr. Malwa rightly said, any startup need to raise successive round of funding during its initial stages, when the quick scaling of the venture is of the utmost prime need. Well, fundraising is not an easy task, and one need to have a very thick skin and a capacity to handle lots of no with never dying spirit to see the light and end of tunnel. Irrespective of the stage of the startup or its goal or the valuation ask, having a right funding strategy is very crucial. So what a good fundraising strategy should answer? At bare minimum, it should answer 5 key things. One is why you are raising capital. So please bear in mind, investors in the market are not there to fund your cash shortages. They are there to fund the idea, the opportunity which they think is highly scalable and solving a bigger problem. Who? From whom you want to raise your capital? One need to thoroughly research their investor to figure out their target, which investor they want to target. A small early stage startup that aims to grow slowly will have a different set of investors in comparison to any startup who want to scale up very fast to be acquired by another player. They may require a different set of investors. So make sure your investors are the right fit in terms of your stage, the sector, the geography, and the ticket size. Third question, how much you want to raise? So don't just pick any arbitrary number in terms of your fundraising size. Base your decision of your, the funds you want to raise based on a realistic assumption. Define clearly the milestone you want to achieve with the funding. It could be a next milestone when you want to then raise the next round, or it could be like 12 to 18 months of projected cash burn. Forecast your funding needs very carefully throughout the entire life cycle of your startup. Fourth question, when you want to raise the capital, one should set very clear timelines. One should not let their fundraising drag on for months, because the VCs or the other investors in the market, they may drag you for time if they think that your fundraising exercise has no time limit. They may focus in the time on the other startups who may be having very clear timeline in terms of their funding, and to keep you engaged, they will keep asking you multiple set of information to make you feel that they have been engaging with you. Fifth question, how you want to raise. So one should also have a very strong clarity on what sort of instrument or what sort of security they want to issue against their fundraise, be it a price equity round or a convertible instrument or any debt paper. So these are some of the areas which any fundraising strategy should very clearly answer. Now coming to making a winning investor pitch. This is a very crucial component of a fundraising strategy, and it's a professional job. That's where the experience of a professional banker comes handy. Also, one also need to do very thorough research on their investor. Every investor is different. Some investors are very hyper focused on the product or the service specifics. Some are not. Some may give too much attention of the technology involved in your startups, while some may just want to learn about your background, your journey so far, and what makes you start this startup. So you should research your investor thoroughly. Don't make a cookie cutter pitch, because the cookie cutter pitch will actually not cut it. An right investment banking team experience, which they gain from successful as well as the failed transaction, plays a very crucial role in making any venture prepared for any transaction or any fundraising or any M&A event. A professional investment banker enjoys very wide network of potential investors, matching with each stage a venture progress, and which in fact exponentially increase the success probability of any startup raising funds successfully. Further, the year of transaction and negotiation experience, the command over the valuation, I would say the benchmarking enjoyed by other competing startups, also plays a very crucial role in achieving a very optimal transaction outcome for any startup. Over the last decade, in this startup, I would say the startup ecosystem is evolving each year passing by. I have observed many startup founders, after kicking off their startup, they place their major focus on raising funds, and also end up with their startup losing their steam because their focus is totally diverted to the fundraising as a priority. So the right strategy call for any startup to partner with the right investment banker. A right fundraising strategy also call for a scenario within the founders place their prime focus on the business. And having said that, I would also like to reiterate that the founders as well as the professional bankers both have their crucial role to play any fundraising process. There is no substitute of a founding team capable of executing and delivering on their business plan in any fundraising assignment. The trust or the lack of it, which a founding team is able to impart in the potential investors, plays a decisive role whether the investors say yes or no. With this, I would like to sum up. The ecosystem of the early startup financing is far more complex now at present than it was a few years back. Fundraising is a very painful but yet necessary task which any startup have to periodically endure. But with enough persistence, dedication, and the grit, the hill can be climbed and the view will be spectacular. Thank you so much.
Thank you so much, Varun, for those words. And with that, I'd like to open up the floor of questions to all the delegates and participants. And whilst they come up with their question, I have one question for Harry, if I may ask. Harry obviously works with a lot of family offices, as Priyanka had introduced at the beginning. So I'm going to ask this question to you, Harry. What do you find currently are the kind of ideas that family offices that you work with in the US are looking to invest in, are looking to back? So what has been your experience when your family offices come to you for making investments? Over to you, Harry, for that question.
I would say there are two different viewpoints there. One is to look at businesses that are undervalued today, or markets that are well established, but the companies, there's a lot of runway that they can have with them. So there might be out of favor today, so they can, analyze that properly. I think on the other hand, they're looking at how do you enhance, the current situation of businesses. So like in the US here, we have, and I'm sure in India, you have residential apartments. And one of the things to do there is how do you then get more money from those residential apartments? And since we deal a lot in real estate, this is a big item. So you're looking at how to enhance the renters, the income that you get from them by selling them insurance, by giving them concierge services, all these things through a high-tech environment. And, so it's very easy for them to do this on a cost basis. So you wouldn't think of real estate and high tech when you're actually providing those services. But there is one company here that is just knocking it out of the ballpark. And a lot of other large developers are trying to copy that concept because they're going to add probably 10 to 15% to their bottom line without a lot of cost. So you're really looking for innovation, but it's not necessarily innovation by itself. It's adding it onto existing businesses and where you can really ramp up your ROI with very little risk. So it's really two different aspects, but I think that those are the things that we're hearing constantly, because all the other stuff in the mainstream, everyone it's like group investing, and they don't want to be part of that because you're going to rise and fall based on how that looks. So hopefully that's responsive to your question.
Absolutely. Thank you so much, Harry. And I think you kind of hit the nail on the head, and I'll try and connect that to what Amit said earlier. And maybe Amit would like to take a jab at this next question regarding real estate. It's obviously a sector which is prime for disruption. Like you said, it's such an arduous task. And one of the aspects that goes into that is the whole trust aspect. And that's one of the reasons why it's so difficult. Do you think that the RERA and the new regulations around the real estate sector are really a game changer and have inspired confidence, and therefore there are more investors coming into the real estate sector, seeing as a source of secondary income, as you mentioned? What is your experience and what is your thought process on that, Amit?
Yes, I do believe that while these have been, some of them have been big, while many of the changes or recent laws have been incremental in nature, they are very essential for changing the landscape. Investors do understand now with RERA, things are in better shape. I would not say that, it's completely, buddies are completely done away with, because how much RERA is followed, and, there are nuances to it, and every state has got its own complication around RERA, since real estate is a state subject. But it's a step in the right direction. I think there's a lot of confidence, and with the next 5 years going to be really good for this sector, which is already showing up in the real estate stocks already, the optimism. I think government needs to keep the foot on the pedal and bring in, define some of the gaps, fill in some of these gaps and define them better. I think real estate is up for a big uptake in the next 5 years.
Absolutely. I think that would be music to the ears of a lot of people. I know Mr. Peer has spent years in that industry, and I'm sure he has something to add. Mr. Peer, would you like to add something to what Amit said?
Yeah, RERA has been a real game changer. It's a fact. But even then, unfortunately, developers have worked around it and avoided their liabilities in most of the cases. See, as a customer, suppose you go to the RERA and you have a complaint and it gives a decision in your favor for interest, penalty, or whatever. Then what the developers would do, they would go to the High Court and drag you on for another 2-3 years. In fact, a couple of days back, there has been an order of the High Court that if you are aggrieved by the order of if a developer is aggrieved by the order of RERA, he can appeal to the High Court only after depositing the interest and penalty with the RERA. So that incentive to drag on the customer for a couple of years is gone. I think it's a very revolutionary step that if you have a complaint, genuine complaint against the developer, and RERA has given in the decision in your favor as a customer, you'll get it. So it will go a long way in improving. So there are, as Amit said, there is a lot is yet to be done, but it's a process, it's going on, but certainly things are changing for the better.
Absolutely. Thank you so much, everybody, once again. And I would just like to end with a quote from the Holy Gita, which was very topical to what we are talking about today, about being the right idea, which says it is better to live your own destiny imperfectly than to live an imitation of somebody else's life with perfection. So with that, I'm going to invite all our panelists and the attendees to follow their own path, follow their heart. And thank you so much for your valuable time. And namaskar to everybody from here. Thank you.
Thank you, everyone. Thank you.
Thank you so much.
Thank you.
Bye-bye. Bye-bye.